The first thing we'll be talking about is charts, candles, and time frame. We discussed pips, pipette, lot size yesterday. Okay, now you know all these things: pips, pipette, lot size, how to enter into a trade with the right lot size, what you might gain, what you might lose, how to calculate the pips. But the first question now is, do you even know how you arrive at what you even want to trade? You are a forex trader, right? But do you even know what the chart is saying? Do you even know what's going on? Do you even know how forex traders arrive at trades, how they get trades? So that is what brings us to charts, candles, and time frame. Looking at this screen right here in this diagram, you can see a forex chart. I believe by now anyone on this call should know what a forex chart looks like, be it on the phone or on the computer. You know what a forex chart looks like already. So, and this is what it looks like. So there are so many components in this image you are looking at. This thing as a whole, this screen as a whole, that is your charts. Then this green and red small boxes are candlesticks. Then we have the time frame. So let me break it down one by one. Charts are seen below. The chart represents the movement of the FX market, and this is where traders analyze the market to get their trade ideas. Looking at this right now, you can see the highs and lows going up, coming down, and the movement generally. This is where, we said in technical analysis, it is looking at the charts to analyze the history of the market in relevance to what is happening right now, using it to predict what will happen in the future, speculate what will happen in the future. So that is when you go for a long or a short. That long means buy, short means sell. So, or you go bullish, which means buy, and bearish, which means sell. So with time, you get to know all these little things. All right, that is what a chart is. That is where you go to analyze the market, to get your trade idea. That is where you do your technical analysis, even your sentimental analysis. It is the movement of the chart you use in trying to enter into the mind of other traders. All right, let's go on. Then the next thing is candlesticks. In the diagram below, you see some green and red candle-like boxes. Each one has some part very thick, which is known as the body, and the top and bottom is tiny line known as the wick, and that explains the name candlestick. Which and excuse me, guys, and each candle represents the market movement for a particular period. All right, let me explain what that means. You see right here, you see this where my mouse is. This right here. This right here. This is a candlestick. Can you see it looks like a candle with the body that you can hold and with the thread on it that you can put fire. But in this case, this is also called body, but we call this tiny thread wick. Wick. It's called a wick. W-I-C-K, wick. All right. So, but that is where you got the name from. But that doesn't mean this is the only way candlesticks look like. All these three you are seeing right here, they are candlesticks. All these three you are seeing right here, they are candlesticks. Everything you are seeing right now is a candlestick. Each and every one of these thing you are saying is called candlestick. You can see some we have wick on top, some we have wick below. Just ask yourself, a candle, when you buy a candle, if it breaks into two, you can remove the lower part. The thread will still be at the bottom, the thread will be on top. If it burns to a particular place, the candle might become small and there will still be thread on it. If it's burning up, so the possibilities are endless. That is the same way everything here can happen. So that is what candlesticks are. I believe you all understand that these things you use in analyzing the market you are seeing right here are called candlesticks. Okay, fine. So if they are called candlesticks, what do they do? What do they actually do? Yes, Japanese candlesticks, yes. All right, so what do they actually do? This candlestick, each one is telling you the market movement for a particular period, and that will take us to time frame. Time frame. each candlestick is telling us what is happening in the market in that time frame. So if you look at this image right here, you will see on the chart, every chart has all these details. When you open it, you will see all these details on your charts. You can see this is a USD Canadian dollar 15 minutes time frame chart. 15, you can see this. You can also see it here. Owanda is a broker, USD 15, telling you this is a 15 minutes chart. And what does that mean? This means each and every candle you see right here on this screen, it takes 15 minutes for each candle to form. Let's say this candle right here you're seeing was started forming 2 o'clock. By 2:15 it will finish its formation. 2:15 the next this red one will start forming from where this one closes, and it will start forming. 2:30 when this one closes, this one will start forming. Go for wherever move it wants, come back, then this one will start forming by 2:45. Then 3 o'clock another candle will start forming. So that is the place of time frame in relevance to the candlestick. So let's say this is a 1 hour time frame. This is H1 or 1H or 1 hour, depending on however you like to call it. So that means each candle must have taken 1 hour to form. So let's say 2 o'clock now, this candle started forming. Once it's 3 o'clock, it will close. Forget the height, the length. Each candle on whatever time frame it is will take the same time to form. So this one will start forming by 3 o'clock. By 4 o'clock, it will close at the bottom. This one will start opening, then form, close 5 o'clock. This one will start by 6, 7, 8. So on a 1 hour time frame, if you see 24 candles, it's representing 24 hours. So that is it. And there are several time frames. So now we understand the chart, we understand candlesticks, and we understand time frame. All right. So the particular period a candlestick represents is determined by the time frame you set your chart to. I said that earlier on. If it's a 15 minutes time frame, each candle will be formed in 15 minutes. If it's an hour time frame, each candle will be formed in an hour. If it's a daily time frame, each candle will be formed in a day. So that is it. This particular period of okay, good. If you are on a 1 hour, yes, I've explained all this. Time frame is also known as TF. So when I tell you 15 minutes TF, or any one of us tell you 1 hour TF, 1H TF, TF is 1H, TF is M15. We are telling you time frame is 15 minutes. All right, let's go on. And there are various time frames in minutes, hours, days, weeks, weeks, months, and years. So example, 1 minute time frame, 15 minutes time frame, 1 hour time frame, 1 day time frame, that's daily time frame, weekly time frame, monthly time frame, yearly time frame, and so on and so forth. In the Forex market, moves to the right. As I said earlier on, inside your chart, you will see that the move is continuously towards the right. The Forex market doesn't go back to the left. It moves continuously to the right without stopping, without going back. You will never see something like this. You see this one now, it should not come back like this and go back like this. No, it's always going forward, right, to the right, okay? All right. The next thing is, and when it's moving to the right, is either going up or coming down. Look at this image. You can see it was going up in this side, then it started coming down right here, but it's still moving to the right. It's still moving to the right. Okay. There are 2 types of trend, namely the uptrend and the downtrend. This image right here on the right, you can see, even though there was up down movement, up down zigzag movements, but overall, if you are asked that this market now, what direction is it going towards, you can see that it keeps going up, starting from this level, getting to this point, and you can see this place marked as reversal point. You can see this place. You can see this place marked as reversal point. When it gets to any reversal point, that is when the trend wants to change. And you can see it start coming down again. Yeah, there are highs, lows, highs, lows, but overall, it started there and is here right now. It's a downward. You can see the arrow pointing. So that is what is called an uptrend and a downtrend. You can see that in the uptrend, the color generally green because there are more buy actions happening, taking the market up. Told you earlier, green candles represent buy. And you can see in the downtrend, the red candles are predominant and the market is selling. That's why we have more red candles, okay? All right, so when the market is only moving sideways, you will know later on, you will see an example of that. When the market is only moving sideways, but to the right, not going up, not going down, then the market is said to be in a range or it's consolidating. It's either you say the market is in a range or you say the market is consolidating. I believe you guys understand that. You don't need to know what's happening when it's in a range or when it's consolidating. All you need to know that the market is not going up, it's not coming down. At that point, it's just retesting that level. All right. So let's talk about trend line now. Trend line. Just a second, guys. A trend line is a straight line that can be drawn to show the general pattern or overall direction of the market. Trend line is mostly used to show the movement of the market over a period of time or correlation between two market prices. Okay, look at this now. Look at this image right here. Look at this image right here. You can see the market started from this point. It came down but came up. But there's something I need you to notice. Can you see that straight line drawn right here? Can you see that at some point right here, the base of the longest, the closest candle is touching it. This one right here is touching it. This one is touching it. So when you are drawing a trend line, this is when you can actually make contacts. Touches, there must be touches on your trend line. So this trend line now, if you look at this line, overall, what side is it bending to or sloping to? It is going upwards. It is not sloping. It is not descending. It is ascending. The trend line looks like it's going up. So that is it, guys. That is what is called a trend line. As you can see, there are different types of trend line. There can be an upward trend line or downward trend line. Okay. All right, let's go on. The upward trend is also known as a bullish trend. The upward trend is also known as a bullish trend. Look at this trend right here. This is called a bullish trend. When the market is buying, it's called, you can say the market is bullish, bull. That same bull animal, bull. The market is buying. So when it's buying, you can also say the bulls are in power and the bulls are trading. The buyers are trading. The market is going bullish. Or there's a bullish candle. When there's a green candle, you can call it a bullish candle. So when there is a move, this move right here, green, is also a bullish move. So you understand better later on what all these terms mean, and that is the basics anyway. But how to apply all these things, that's it. All right. Okay, let's go on. So the downward trend is also known as bearish trend. It is overall movement of the market price towards the bottom of the chart. You can see the arrow is pointing towards, it's coming down towards the bottom of the chart. And it's called a bearish trend. Bear, just like teddy bear, the bear animal. Bearish trend. So all these red candles are bearish candles. Even when they are here, if it is red, it is bearish candle. And these green candles you are seeing right here, all these are bullish candles. The bulls are trying to take the market back up, but the bears keep pulling it down. So it's safe to say when you are buying, you are a bull, and when you are selling, you are a bear. Okay, that explains trend line, bullish trend, and bearish trend. So the next thing we'll be discussing, and which will be the last topic I'll be discussing before I invite our darling Nancy to continue the class. So this is support and resistance. Support and resistance is a very important part of technical analysis. It is a very, very vital and important part of technical analysis. If you do not know, please can we just jot down, sir, the notes on trend? Yes. When the market is going up, it's called an uptrend. When the market is moving downwards, it's called a downward trend. And you can call an uptrend a bullish trend. while you can also call a downward trend a bearish trend. That is everything there is to trends. And trend line is when you can actually draw a line through the obvious touches of the trend. Look at here now. Look at this place. There's a touch. There's a touch. There's a touch. There's a touch here. So if you look at my mouse, I can safely draw a straight line. When I draw that straight line, I have just drawn a trend line. This is a trend. It's trending upwards. But the line I draw right here is a trend line. If it was going down, if I draw the line right here, the straight line is a trend line too. So that is it on trend line. Support and resistance. You see, in technical analysis, support and resistance is one of the most powerful things you can ever learn. Support and resistance is one of the most powerful things you can ever learn. If you can master support and resistance, even without knowing any other thing, you'll be on your way to success. Just learn one or two few tricks with support and resistance. So what is support? What is resistance? As you can see right here, the market started from this point. The market started right here at this point. Then it started going upwards. You see this upward movement, it will be several candles, red, green, 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 red, green, red, green, green, red, green. And it got to this particular point. You can see where resistance is written. It has gotten to a point of resistance where the market is resisting the price. There are so many sellers waiting right here that wants to take the market down. Say, we want to sell, enough of buying, and the buyers won't have any strength to stop them. Then the market will start selling downwards. And when it gets to the point again, it will get to a point of support where buyers are waiting already too. That see, at this point, we are taking back the market. We want to take it up. Then they will start buying and take it all the way up again. And like that. So that is why it's safe to say Forex is just pure repetition. You have to understand what is being repeated in the market, the movement of the market in a particular period of time. And you'll be able to analyze it properly alongside a few indicators just to be sure and a few strategies. And that is it. You have your entry into the market and you take whatever you want to take, you strike and you jump out. All right. So why is this place called resistance? It is a point where the market can no longer go up again. It's also called a ceiling. So let me give you an analogy. You are in your room. You stand on your bed now. Then you jump on your bed and you get to your ceiling. What is it going to do? It will stop you. It will resist you. Resist. Ceiling. Your ceiling will resist you and bounce you back down. Then when you are landing, at this point, you were resisted from going up again. Then you are coming down. When you are landing, what will give you support? The floor. The floor will give you support. Support is the floor. You can see this is the top, this is the bottom. The support is giving the market a floor now to land on before it bounces back up, touches this place again, reverse and bounce downwards at the resistance, just because you cannot crash through your ceiling and go out of the roof. That is the same way the resistance will not allow the markets to go. Yes, there's an exception to that. Sometimes there's always breakouts, but you get to understand why these things happen later on. So I believe I've been able to make it very simple. Resistance represents the ceiling, while the support represents the floor. Each time anywhere you are, there's always a floor, there's always a ceiling. Whatever room, whatever mall, office, there'll always be a ceiling ahead of you. There will always be a floor under you. So if you don't ever forget this, that the floor you are standing on is supporting you, and if you jump up, the ceiling will resist you. You will never forget the concept of resistance and support, also resistance. All right. Looking at the diagram, the zigzag pattern is making its way up, also called a bullish trend. You can see this is a zigzag pattern formed by several candles. Forget the fact that it's drawn in lines. This thing you're seeing is formed by several candles. And it is actually making its way up. This is an upward trend. Looking at it generally, see, it started, this is where it is right now. So overall, the movement is bullish. It's a bullish trend. When the price moves up and then pulls back, the highest point you reach before it pulls back is now resistance. Can you see? It's going up, then it gets to this place and has no choice than to pull back. This place is resisting the market from moving forward. So that's where the pullback happens. Okay, all right. Resistance level, also known as the ceiling, indicates where there will be surplus of sellers. I said it earlier on that when it gets to the resistance, which is also the ceiling, so many sellers are waiting there, and that is the place of pending orders. Later on, you will know what pending orders are. Let's say I have set a buy stop there, I have set a buy limit there, I have set buy as a buy execution there. I have said so many things. This one I've set, you have said, that one I've set. We will overshadow the buyers and we will just take the market down because they are not ready to buy anymore. We want to sell. That is the place of resistance. When the price continues going up again and the lowest point reached before it starts back forms a new support. You understand? Let's say it's coming down now. The lowest point it gets to before it starts back up forms a new support. And this indicates that there are so many buyers right here that are going to take the market upwards. So the sellers will become weak. They won't have a choice anymore. This is also the place of sentimental analysis. Looking at support and resistance alone, you can predict what other traders want to do. When you mark out your support and resistance, that obviously these people are going to buy. So what do? Let me buy with them. Or I don't want to buy with them. Let me see what they want to do. Let me wait for a breakout. The possibilities are endless. That is why you have to understand technical analysis, fundamental analysis, and sentimental analysis. But that is not for you right now. That is not your place. You just focus. When the time is right, you will learn all these things. Okay. All right. So, and yeah, when the market is in a downward trend, reverse is the case. When it's in a downward trend, imagine this will be the resistance, this will be the support, a new resistance will be here, a new support will be here, a new resistance will be here, a new support will be here. It's just as simple as that. All right. Support and resistance is traded majorly in two ways called bounce and break. Bounce and break. So if you want to trade bounce, you buy when the price drops towards support and sell when the price gets to the resistance. Look at this. You want to bounce off, boom, you get to the resistance, then you bounce with it. You bounce with it downwards. You sell because you know there are so many sellers there. So you bounce from this place and sell with them. Then when you get this place again, you bounce up again and buy. When you get to this place again, you bounce down. So that is the place of using support and resistance to trade bounce. Resistance. Both of them are reversal points, David. Both of them can act as reversal points and they can also act as breakout points. So don't get it wrong. Support is support, resistance is resistance. Okay? Support is support, resistance is resistance. Both of them can act as reversal point, both of them can act as breakout points. Okay? So that's what I'm telling you about bounce. It is reversing. When you are buying or selling, when you are buying or selling reversal, that is when you are bouncing. When you are breaking, when you are trading break, you can buy when the price breaks the resistance upward or sell when the price breaks the support downward. See, let's say you now get to this place now. Instead of it bouncing, you've marked out a strong resistance here. You've seen it. But when it gets to this place, it decides to test this price. And it will just jump out. It will jump out. It will break out. That is when you buy the break. So if you have the right indicators to tell you the market will break out at that point, you just go for it. You not go for a sell that others are going for. Sentimentally, everybody will want to go for a sell. But technically, you will be going for a buy because you are anticipating a breakout. So that is the place of using support and resistance to trade bounce and break. Both are reversal points, both are breakout points. Don't get it twisted. Both are reversal points, both are breakout points. I believe I've been able to actually explain the concept of support and resistance, and that is it, guys. So I'll call Nancy now to come and continue the class and start from entry price, take profit, and stop loss. Thank you so much, guys, for paying attention, and I believe you've been writing because it will actually help you. It will really help you. Writing things down will help you. Ademakin, thank you too. Thanks, everybody. All right, so now let me make Nancy the host so she can continue the call.
Okay, so I was talking about entry price, right? I said entry price, which place your sell order and takes you into a trade. For example, you want to buy Euro USD at a particular price of let's say 1.1795. At 1.1795, before you enter this price, you must first analyze the market structure. You must first understand if the market is going up or it's going down, if it's an uptrend or a downtrend, if it's going long or going short. You must have to know all those things, and that's why you need strategies and indicators and all of that to understand where exactly the market is going. If you are to buy any currency pair, it simply means that the market must be in an uptrend position, and if you want to sell, it must be in a downtrend position. So before you take any trade, you should always confirm where the market is going to before you take any trade, right? So before you enter a buy trade of Euro USD at 1.1795 for a buy, you should also make sure you have your TP and SL in place, which is your take profit and your stop loss. Because without your take profit and stop loss, it's not really advisable to enter a market without take profit and stop loss, or else you might just blow your account to zero, right? So take profits is an order that is placed to close your trade in profit once the market reaches a specific price. It takes the profit as it closes the trade for you automatically. So I'm going to use an example. Let's say you want to buy Euro USD at 1.1795, and the current price is maybe 1.1785, right? Sorry, if you want to enter a trade, rather, it is and the current price is 1.1795. You have to set your take profits in whatever pips you wish, maybe 10 pips, 20 pips, depending on your depending on the gain you want to have, right? So for take profit, let's say we want to use 10 pips right now as a take profit. 10 pips would be 1.1805 from the current price, which is 1.1795. The take profit will be, for 10 pips, it will be 1.1805. And also depends, it comes with your lot size. It depends on the lot size you're using. If it's 0.01, 0.10, 1.0, and it depends on the amount of money you have in your accounts, right? So the take profit will be 1.1805. That is where you should set your take profits. So if hopefully for you, if you actually analyze the market very well and you expect the market to go up, and you set to buy at that Euro USD for 1.1795, and you set your take profits for 1.1805, and the market eventually goes up in your favor and it reaches the take profits, the price, which is 1.1805, you automatically, the trade automatically takes you out with a profit of $10 using a 0.1 lot size, right? So the higher the lot size, the higher the profits you make, but that should also depend on the amount of money you have in your accounts, because you cannot use higher lot size with small money in your accounts. It's not possible, because you could, except if you're willing to lose, like blow your account, and nobody wants to blow their accounts at all. So, and that's is also what they call risk management. You have to have a proper risk management, but I won't talk about that now. Tomorrow you will learn about risk management. So let me talk about stop loss now. So like I said earlier, the market goes up in your favor and it hits take profit of 1.1805, and you gained $10 from the take profit, right, from the trade. Now, if it's for stop loss, the market goes against your favor and then it begins to go down. So The moment it goes down, you start to lose money, and then it hits your stop loss, right? So your stop loss is actually, stop loss is a function used to limit your losses, right? So if the market isn't going in your favor and is moving against the initial direction of your trade, it takes you out of the trade once the price hits stop loss, cutting your losses. So stop loss basically is, it just helps you limit the amount of losses you make in a trade, right? So like I said, if the price was going up in your favor, if it was a buy trade and it actually goes up, you get your take profit of $10. But if it doesn't go up and the market ends up going the opposite direction, which is downwards, which is a sell, and then it ends up eating your stop loss, you automatically leave the trade. The trade actually takes out of the market takes you out of the trade automatically, rather, and you lose $10. So so stop loss is more like risk management, right? You have to know, you have to uh, you have to set a stop loss. You have to set a stop loss. Hold on, please. I'm trying to check. So yeah, your stop loss is basically the to limit your losses. So like I said earlier, the more lot size you use, the more you lose money or the more you gain money, depending on where the market is going, if it's an uptrend or a downtrend. Okay, so to round it off here, take profit is basically the trade. It's an order that is placed to close your trade in profit once the market reaches a specific price. It takes the profit as it closes the trade for you automatically. When the market goes up, if you're in a buy trade rather, and the market goes up, once it hits the take profits, it takes you out of the trade automatically with whatever profits you make, right? Depending on your lot sizes, your pips, and your risk management. Same goes to stop loss. If the market goes against your favor, if it doesn't go, if you're in a buy trade and it doesn't go up, it goes down instead of up, it comes down and hits a stop loss and it takes you out of the trade with a loss. Okay, so let me move on to orders and entry. Orders, entry, and exits. An order is an offer you send to your brokers using a trading platform like MetaTrader 4 to open or close a transaction when some specific conditions are met. And this will in turn activate a trade for you. You can simply say an order is how you will enter and exit the market or a trade. Now we have like two types of orders rather. Orders fall into two categories: market execution, which means an order instantly executed against the current market price on your trading platform, right? So market execution is entering a trade at the current market price. Buying and selling by market execution is selling instantly at current price, right? Pending order is an order to be executed later on when the market price reaches a specific price of your choice. So market execution is like, for example, if you want to enter a market or a trade right now. So once you enter a trade, you're automatically in the trade and then you buy or sell. That's what market execution means. It activates an instant position. Like you want to enter a market right now, you want to take a trade right now, you want to buy or sell right now instantly, right? So buy stop is, now for buy stop will open a position at the price higher than the current market price. So a buy stop, right, is when the market is continuing to rise up in one direction and what you are expecting the market to do is to break a specific price line. So if the price were to rise up and break that specific price line, the buy stop will activate and automatically put the buyer in a buy. It will automatically put you in a buy at that current price, right? So for example, let's say you want to buy Euro USD at 1.1795, right? And you set your buy stop above the current price. The current price is, to identify your price, like I said earlier, you have to check your charts to identify that. And so if you want to enter a buy trade, you want to buy Euro USD at 1.1795, for example, and you set your, let's say you set your buy stop at 1.1805, right? You have to set your buy stop above the current price. This means that when you're in a buy trade and the price begins to go up, right, you expect the market to break that specific price line that you've set, and the market begins to go up. It goes higher, it activates the trade for you, and it begins to go up in your favor. And then you begin to go into profits. And of course, you have to set your take profits also. So whenever it reaches your take profits, cash out and leave, right? So that's basically what buy stop means. It automatically puts you in a trade once the market goes up and hits the specific price line where you set the price. So once it hits that price line, the market automatically opens for you and you're in a buy trade, and then it goes up and you begin to make profits. So for a self-stop is the opposite of buy stop, and it is when the market goes down in one direction, which is a downtrend. You expect the market to break a specific price line where you set the current price, and self-stop activates and automatically puts you in a sell position, right? So instead of, okay, now I said earlier if you want to buy, so this time you're selling Euro USD. So once you set the price, once you set the price you want for the sell stop, and the price begins to go down, it hits that price and automatically the trade opens for you, and then it goes down again, and then you start to be in profits, right? So a sell stop is placed below current price, and a buy stop is placed above current price. All right, so let me move on to buy limits and sell limits, right? So buy limit is, when you open a buy position at the price lower than the current market price. Now, a buy limit is where you place a buy order at a specific price below current price. Remember that buy stop is placed above current price, right? But buy limit is placed below current price. Once the price hits buy limits, such as like the resistance or support inside the market, like Radio said earlier, it talked about resistance and supports, right? For a buying limit, you're expecting the price to go up, expecting the price to go high, right? To go long, it's supposed to be an uptrend, right? So once you set the buy limits below current price, it comes down, it makes a retest or a pullback and hits the support or resistance. Oh, it's going to be support because right now it's a buy trade. If it was a sell limit, it would be a resistance, right? So once price hits area, and once it hits the buy limits that you set below the current price, it automatically opens a trade for you, and then price begins to go back up, right? So you set the buy limit below the current price because you know that once it comes down, it hits the price you've set, and then it begins the market opens up for you, and automatically you're in the buy trade again, and then the market goes up, and then you begin to make profits, right? And sell limit is where you place a sell order at a specific price above current price, right? So once price hits the sell limit area, it opens up a trade and begins to go down, and then you begin to make profits, right? Let me give an example. Let's say Naira, for example, right? Let's say Naira is 430, right? And then you feel that, or you think that price will go down. You feel or think that price will go down to a particular amount. Let's say price goes down, or Naira goes down to like 400, for example, right? So the moment it comes down to that 400, you also think that once it comes down to 400, it's going to go back up to maybe 430 or 450 or as high as possible. So once it comes down to 400, that is when the price automatically puts you in a sell. No, sorry, that's for buying limits, right? So for sell limits, you expect the markets to come down below, above the current price. So once it goes up, it hits, let's say it goes up to like 430 rather. So you feel that, or you think that the price will come back down to 400. So if Naira is 430 now, you feel that it goes up to a specific price and then it comes back down. So once it hits the sell limit area, it opens trade and you begin to go down, then you begin to make profits. Okay, so I'm gonna invite someone else. I'm gonna invite one of my colleagues right now, Tyler, on board and just sit. So let me make her the host right now.
All right. So I'm guessing, everything is new to you guys, so you all should take it easy and try to, have an open mind to this. I know it's quite a bit complicated, but I'll try my possible best to simplify it for you guys. So, like my colleague said, Nancy, there are two types of orders. Okay. We call them orders because we're placing an order in the market. Whether you're buying or you're selling, you are placing an order in the market. Okay? So for instance, you want to buy gold. You are entering a buy order for gold. Do you understand? So the two categories are market execution and pending order. All right? Market execution is I want to buy this particular currency pair now. Okay, so you're entering the market now to buy at that entry price. All right. So pending order, they have four types. That means I want to buy Euro USD, but after doing my analysis, price hasn't gotten there yet. Okay, so what do? I place an order. You know when you want to buy food now? When you want to buy food in the market, or don't let me say in the market. Let's say you want to order online. What do? You place your order, right? And then they'll give you a particular time your food will be ready. So just have that at the back of your mind. So when you're placing an order, it's because you want to buy at this specific amount, but price hasn't gotten there yet. And instead of you waiting or doing whatever you're doing, and then you come back and you see that, oh, price has even passed where you wanted to buy. So you place your order and go about doing whatever it is you do. Okay? So you place the order and your broker helps you activate your order when price gets there. All right? So let me take the first one, the first type of pending orders we have. The name is even self-explanatory, pending order. Okay? So if you understand the market execution and what pending orders mean now, can I get order in the chat box before I start explaining the types of pending orders we have? Order. Great. So I will start with a buy stop. Buy stop, when you're setting a buy stop, your buy stop is always below. Can you guys hear me? You're saying join again. Wait, can you hear me? Can you hear me? Okay. Thank you. Thank you. So your buy stop is when you place your buy stop, you're anticipating that the market is going to continue to rise up, right? Okay. So your buy stop is above the current price. I want to buy Naira now. Naira is 450. I'm seeing the entry price on the chart. Naira is 450. And I did my analysis and I'm like, okay, Naira might get to 460. You know, Radio explained support and resistance. Let's say Naira has been trying to break resistance of 460, but it hasn't. Okay, it keeps on coming back down to 450. So I'm not like, oh, if price breaks above 460, that means Naira is going to keep on buying for a very long time. That means there are large amounts of buyers in the market. Okay, so I'm placing my order above the current market price. So if it breaks, it will hit my pending order, which is my buy stop that I placed, and then automatically puts me in the trade and starts going in my favor. That way, I'm able to do whatever it is I do on a normal day. You don't have to sit with your phone. Why? Because you've already put your take profits and your stop loss. You're good to go. And remember, there are only two things that can happen once you place a trade. It's either it hits your take profits and takes you out of the trade in profit, or it hits your stop loss and it takes you out of the market with little loss. Remember, your stop loss is like your bodyguard. It is what is shielding you in the market. That way you don't lose all the money in your account. Because anything can happen. There can be a news release. The banks can release news and then probably Naira is getting weaker or something like that. What will happen? The market will start going down. People will start, because sentiments from sellers, they'll start selling immediately. So what will you do? It will take you out of the market with little loss. So that is why it is very paramount to always set your stop loss right. Remember, do not risk more than 2% of your account. I'm very sure we all know how to calculate 2% here. So your account size, calculate 2% of your account size. That is the amount you should be willing to risk, okay? If the trade doesn't go in your favor. So if you understand buy stop, can I get stop in the chat box before I move to sell stop? Great. So your sell stop. Your sell stop. In your sell stop, your entry price is always below the current market price. What does that mean? It means that there are buyers in the market, and after analyzing your trade, you're like, I can't sell this thing now. What if it continues going up? Okay, you know what? If it gets to this support, if it breaks this support, let's say Naira is at 430 support, okay? I'm not like, if it breaks 430, that means there are a large amount of sellers in the market. So that means the sellers have the power in the market. What do? I start selling at that point where price breaks the support. So if I now say, if price breaks 430, I'll replace my sell stop as 420. Remember, when you're selling, price goes down, keeps on going down. So you place your sell stop as 420. That is below the current price, which is 430 now. So when it breaks it hits your sell stop, and it's automatically, your broker automatically puts you in the trade. All right. So once your take profit and your stop loss are in place, you are good to go. You can set your sell stop. We analyze trades. I myself analyze trades, and I just put, sometimes my trades are pending orders, and I go about my day, and then I come back and I either see whether I profited or I lost the trade. In fact, sometimes I already know how much I'm going to lose. So there's no need to panic or anything. Why? Because you're risking only 2% of your account size. So if your account size is let's say 100, I am willing to risk like $1 or $2. Okay, if you lose $2 from one trade, you're not going to fret. because you still have $98. You're not losing your whole $100, and then you can either profit $3, profit $2, profit $4 from here. So the essence of having a stop loss is to always limit your losses. So I'll go on to buy limit. So buy limit is when you set a buy position at a price lower than the current market price. All right. So let's say, for instance, price of I don't know why I'm even using naira. So let's say naira is 470, right? And you're not like, remember, you always want to buy low. Always buy low. Radio explain that later. Buy at the support. Do not buy at the resistance. Always sell at a premium and buy low. Okay? So you set your buy limit at a price lower than the current market price, because why? Maybe you enter the trade and then you're like, oh, I analyzed this trade. I was expecting naira. I wanted to buy naira at 470, and naira is at 480 now. The market moves up and down. So what happens? Price, there will be a pullback. The pullback will be little, and then you're like, I expect price to pull back from 480 to still come down to 470 before it starts going up, before it starts shooting up. What do? You set your buy limit at 470, okay? And then once it pulls back to that, it hits your buy limit and it puts you in a buy trade. Your broker automatically activates your trade into the market. So it's like I'm placing my order and putting it in the hands of my broker that this is my order. Once you see market gets to this place, activate me into the market. So it will activate you into the market and then do what? Start going up in your favor. Your take profits and your stop loss also will be in place. So that is buy limit, okay? Your order is always placed below the current market price in the buy limit. Why? For a buy stop, your order is always placed above market price. You can use it, you can form a song. Buy stop, order placed above price. Buy limit, order placed below price, okay? You don't expect yourself to understand everything at once. Don't worry, we'll show you. Dr. Essay tomorrow will be taking you on opening your MetaTrader 4 and opening a demo account rather on your MetaTrader 4 app. So she will show you all the types of orders. It's nothing complicated. It's just the name and the grammar. So for sell limit, a sell limit is when you place your sell order at a price higher than the current price. Okay? You are placing your sell, you want to sell at a premium. So you're like, naira is 470. And you're like, before naira will start to sell, if to get to the resistance area, let's say the resistance is 480 or 490, you're like, price you get to 490 and bounce back because it can't break it. So once price gets there, you expect it to start selling. So what do? You place your order. Say, hey broker, I want to sell naira when it gets to 480. When it gets to 480, please open my position, put me into the trade. Okay, let my trade activate, and then once it gets to 480, your trade will activate and start dropping down to your TP, and it hits your TP. If it doesn't, it will reverse and go and hit your stop loss. So is that clear? I hope I've been able to simplify it. Do you understand right now? Please, can I get understand in the chat box? Oh, thank you guys. Thank you. That is great. Right. So any question? Do you have any question? Any question at all? No question. So I might have good in explaining. We need material. Chem fund. Which material? To read more, Radio put a link to the YouTube channel, so you should be able to watch the basics there. The videos are there. You have to subscribe though. towards the basics. We've simplified it into videos for you guys, so you can always go there to watch. Who is Ruth? I just joined back. I don't understand everything. How is that my problem? Why are you just joining? We can't wait for you. Go to YouTube video. How do we decide strategies and indicators to use in analyzing the market? Indicators are quite simple. Don't worry, they'll be on your MT4, on your MetaTrader 4 app. You will see them. Okay. Can I cancel trade if I feel it won't get to my take profit? Yes, now you can decide to cancel the trade anytime you want. If probably even if it doesn't get your take profit, maybe you see, oh, I'm expecting to gain $10 from this. I'm at $6. If you're comfortable, you can close your trade. You can always close your orders anytime you want. Even before it even gets to your stop loss, you can decide to close your order. Okay. Please scroll down a little. I'm taking notes. Amy, no taker. I love taking notes also. That's good. Network issues. Okay, you know what? For the last time, we might provide the recording of this. Your people should always come for classes. I mean, we did this from our busy schedules for you guys. We don't owe you anything, but we did this from the goodness of our hearts. So please, always appreciate our time and come for classes. Do not bank on watching recordings. Recordings are just to go back if something is not clear to you and watch it again. All right, there's nothing like one-on-one teaching because you can ask questions. We open the floors for questions. Okay. If you don't understand the basics, who is Tayo? Innocent, my name is Tayo. I'm not Mr. Tayo. I'm the lady. This is Oluwa Tayo. Radio is the Mr. Tayo. That's my namesake. So that's about that. Yes, Oluwa Tayo. Yes, I'm using my colleague's ID so I could explain to you guys. Thank you so much. So always try to come for classes, all right? So thank you. The class was interesting also. I enjoyed it, even though I was explaining. I enjoyed Nancy's teaching. I enjoyed Radio's teaching. Nancy is quite good. You guys get to know our data. Yeah. So I have to hand it over to Radio right now. Radio, are you there?
All right, everyone, guys. Tayo and Nancy have been able to do an amazing job of actually explaining the other parts of the class to you guys. They've done an amazing job in doing that. We really appreciate you guys, and bye. Okay.